Okay, I think we covered some part of the theory before we started our these things. Okay, so there are forward, futures, options, and swaps. Okay, we'll do swaps also a little bit. Forward we have already done in currency market. So and of course stock market there are no forwards as such. Futures and options. Okay, we are already doing. So these are the indexes. Okay, which we have taken position Nifty. You can take position in Nifty Bank, Nifty Financial Services, Nifty Mid Cap also. So there are, I mean, 4 or 5 kinds of, this thing. And then stocks, there are 197 stocks as of today, where you can take either a long position or short position in the futures. And the trading cycle is, so this is a lot size of, Now, this is very important. Whenever the months are, so please listen here very carefully, okay? So whenever, the month starts, the stock exchange gives you the future price for the new contract. Otherwise, the market drives the price of the, future of the stock as well as the index. Fine. So at the beginning, on the first day, the market, the stock exchange will give you the price. And this is the formula which is on your screen. This is the basis price. So future is equal to S plus C, which is, future would be either the plus spot plus the cost of carry. Fine. So just to give an example, suppose you go to the market, okay? You want to buy, apples, okay, or mangoes in the summer month, particularly. That's a very apt example. So you went to the month in the month of May, June, you get mangoes, okay. So mangoes are available at say 200 rupees a kilo. So you can buy in the spot market easily. Okay. Now there are certain places you can get mangoes in the month of December also. You go to Khan market, you will find mangoes. Now it is available with many big shops. Mangoes are available. So what they do, they place an order with the wholesalers and who have tie up with the farmers, and you place an order for mangoes for delivery in futures in the forward market to be delivered in the month of December to you. Okay. So now this was started way back in America, because that time the farmers were producing those crops, and and they were getting spoiled because sometimes they overproduced or sometimes they underproduce. So they found that they were not making enough money. If they overproduce, they will get, rotted out, because there was no cold storage those days. And so the futures and forward contracts were brought on the stock exchange so that you can place your order. And that, again, in the agricultural reforms which were, brought by this government, and which was, not liked by the Punjab farmers. So they wanted to bring this into it. So they said, okay, you can buy, anything, even in the futures also, like December mangoes you want. So now the farmers would know that how many orders they have received in the month of May or June or April, how much they have to, produce, how much they have to give a delivery in December, how much delivery of mangoes in January, for any kind of a thing now. I'm just giving example of mangoes. So what they'll do, they will, produce those mangoes, and they will be kept in a cold storage, and will be readily delivery will happen in the month, whatever month you want. Now, when you ask for the rate for December, what they'll do, they'll calculate the price of the order. Suppose it comes to 50 lakh rupees. Okay. Now the farmer money will be blocked. Okay. They will be taking some kind of a small amount from you as a token amount, and there will be some kind of a interest cost, which somebody will be bearing it. Okay. And ultimately the person who is ordering, he has to bear it. So the interest cost plus the go down charges, because then it will be kept at a go down. So they will work out and say today the mango is 200, but delivery December rate is 300 rupees. So it will be the storage cost, which will be the cost of carry, finance cost, and the storage cost will be added, and the price will be given to you. And then you place the order on the month of December. The mangoes will be taken out from the cold storage and delivered to you at a price which is the spot price in the month of May plus the cost of carry. So this, formula is the future price equal to spot plus the cost of carry. Now, cost of carry in case of commodities is basically the interest cost plus the go down charges. But in case of stock, it will be the interest cost, because somebody, you have placed the order to someone, so we are assuming that he'll buy the stock and deliver to you. Okay. So there will be an interest cost minus the dividend, basically, because the companies can give dividends. So suppose I've bought the stock for you. In the meantime, the dividend is declared. So I'll be getting the dividend. So I have to pass on in the cost benefit to the guy who has bought from me. So it will be, I'll just show you here. Dividend आपको मिल रहा है. I mean, suppose there is a dividend on mangoes. I will be getting mangoes dividend. So my cost will go down. So that means the future price will be less because of the dividend income which is coming to me. Okay. So similarly, the person who is holding the shares and he is to deliver, he'll be getting dividend. Okay. Normally it is a dividend, the annual dividend divided by 12, and then you calculate how much percentage of dividend you get, and that percentage along with interest is, I mean, either minus or reduced. Okay. So let's understand this example. Okay. It is coming, I think, in the later part. So this is, if you look at anytime the screen, they will have 3 months window. Okay, like I just saw in December when I'm preparing this slide. So there are 3 contract expiring happening every Thursday of that particular month. Okay, fine. So index futures, lot size is 50. I told you. Okay, so this is important. Okay, so this is, I just give an example. There is a cash market and there's a future market. So future market is equal to spot plus cost of carry. Okay, and if you see the graph there, the future price and the spot price converges by the end of at the time of expiry, because at the expiry, your trade will be settled at the capital market price or the cash market price. हाँ जी. The cost of carry is equal to the financing cost, or we say cost of carry is equal to interest cost plus minus the dividend earned. No, interest cost, is basically the cost. I mean, borrowing cost. When you RF is basically the borrowing cost of the government. Okay, fine. So it will be, now they can't determine individual interest cost. So it has to be normal borrowing cost. Fine. So if a person borrows by lending the shares, suppose you pledge your shares and you get some cost. So it's around 12%, 1% kind of per month. So if you have shares and you go to the bank and say I want money, so they'll give you 50% loan against that. And if you use that loan, they're going to charge you 12%. Okay, so assume it is around 1%. Fine. So that is not very important. So they have a formula. Okay, we can check, how much interest they are. So it's a SBI lending rate they are taking for. I mean, I just remember it was SBI lending rate which they, choose the base rate. Okay, fine. So that rate. Now, of course, it is the marginal lending rate, MCLR rate, which they are taking. Okay, so the Reliance Industries spot price is 2,584, and on 27th of December, the future price was 2,628. Okay, which carried, yeah. Spot price, and listen to me. Just I got your question. If I think I've got it right. When the stock exchange is giving you the price, say on the first of, on the Friday, when the new contract opens, it can be any day. It can be, 30th of December or 1st of January or whatever, which is the first Friday of the, after the new month starts. So because the last price, which is the capital segment price, becomes the basis price. Okay, that becomes your, the spot price plus the cost of carry to that. बिल्कुल. You see, whatever is the price, the counter starts from the spot price, because the spot price and future price, they almost converge at the month end. फाइन. अगर आपका स्पॉट प्राइस चल रहा है तो फ्यूचर जो है वो एक दिन पहले का फ्यूचर तो मार्केट जो प्राइस चल रहा है दैट इज हाफ एन आवर वेटेड एवरेज प्राइस, बट द लास्ट डे व्हेन द ट्रेडिंग एक्सपायरी इज हैपनिंग, it's a cash price becomes the spot and future price the same thing. Everything converges into one. ड्रॉप भी होता है, कम भी होता है, 10-5 पॉइंट ऊपर भी होता है, नीचे भी होता है. अगर सपोज वो नीचे था तो वो ऊपर भी हो सकता है. मतलब 2-3 पॉइंट का फर्क होता है, ज्यादा इतना फर्क नहीं होता है. हाँ, वो एकदम एक्सपायरी तक प्राइस फ्यूचर और एकदम ऑलमोस्ट नियरिंग आने में आ जाता है. अगर निफ्टी 22,000 पे है तो क्या कहते हैं स्पॉट का, तो फ्यूचर भी वहीं पर ही आके हट जाएगा आपका. ये नहीं कि वो ऊपर नीचे होगा. एक महीने पहले तो कॉस्ट ऑफ कैरी है और उस दिन तो देयर इज जीरो कॉस्ट ऑफ कैरी ना. जस्ट थिंक दैट ऑन द डे of delivery, there is no cost of carry. The cost of carry has to be zero, isn't it? Because there is no interest cost involved, there is no go down charges involved when you're taking actual delivery. Is that okay? So logic comes from there. Okay. Okay, so now let's move on to the next one. So the important concepts, okay? Okay, so when you are bullish, you take a long position, buy futures. We are doing only futures at the moment. If you are bullish on a stock, you buy futures. Fine. Now you can, if you are bearish, you're going to take a short position, you're going to sell futures. So if you are bearish on a stock, sell futures. Now there is another chapter which is called risk management. This thing, because there is a risk involved. There is a counterparty risk which can be there. When the two people trade. So the stock exchange has made a foolproof system that the transaction gets, fully honored and nobody loses on account of that other person doesn't have money. Okay, fine. So there is a risk management technique which guarantees the transaction. So I'm just skipping one or two slides which are just theoretical in nature. You can read them. When it's, So there is, what system they follow is, they call it risk management for derivative product is managed by the standard portfolio analysis of risk, this thing, and that's called SPAN. So there's a software, SPAN software, which determines the margins for the Nifty as well as any stock or any index based on the volatility of either the index or the stock. How, if the stock is more volatile, then the SPAN will calculate a higher margin. Okay, because then the stock is very risky. Okay, so there's a chances of the stock moving here and there are much this thing. So more volatile, more the risk, more margin has to be collected. हाँ, absolutely. हाँ, वो span हो गया तो आप उसको span ऐसे भी करते हो, but span तो नाम है, standard portfolio analysis of risk, that is the, I believe that is the, हाँ, span ही होगा. Okay, ठीक है. So here the span system assumes what is the maximum loss which can happen on a single day. Okay, on that basis the margin is determined by the software. We're not going to that. There is a separate slide for me. I can just share with you. You can read that how it works. Okay, so we'll do some more, span and other thing at later part. So some important concept, initial margin. So a person has to deposit a margin which is called the initial margin, which is the span margin plus the extreme loss margin. There are two kinds of, and the third one is called the ad hoc margin. Okay, so there are three kinds of, all put together, margin is combination of three things. Okay, the span, extreme loss margin is coming on my slide. So let me come to that. Okay. So they are clearing members and trading members. Okay, so this is only for the people who want to actually trade and know, what is the thing behind it. So clearing member. So there are some clearing members who are supposed, the job is given to them to ensure that the transactions get, cleared, all the stock transactions. Okay, fine. And they're trading members. Like the ICICI is a trading member. And there's one person who is called the clearing member. I'll just show you what the bodies who have been designed as clearing members. Their main job is to ensure that all the margins are collected. And the trading member job is to see that all the clients who are placing the order, their margin is collected. They pass on to the clearing member and the transaction becomes foolproof. So I'm not covering that. You can just look at this thing. So these are the clearing members. Now, who are the clearing members? Aditya Birla Sun Life Mutual Fund, Axis Bank Limited, Bajaj Alliance Life Insurance, and Bandhan Bank. So these are the clearing members. Okay, fine. So their job is to see that the stock exchange is smoothly functioning and all the margins are being collected from the trading members, and trading members are collecting the margins from the clients. Okay. Now we come to the, apart from the span, there is something called extreme loss margin. Okay. So I told you, there are three kinds of, money which has been taken from the investor when he places the order. Okay. First is called the span, which is based on, maximum loss which can happen on a single day. On the basis of that, some kind of a money is collected as a margin. The second is called the extreme loss margin. Now, there's two figures which are there. Suppose it's an index derivative. So 2% of the notional value. And notional value is the future price of the index or the stock. And stock derivative is 3.5%. Fine. So these are the span margin plus 2% on the notional value of Nifty will become the total margin. In case of very volatile trade, so there is a ad hoc margin which is also collected, which I have not mentioned here. Okay. अगर कभी-कभी बहुत ज़्यादा volatility हो गई है, so the stock exchange may introduce something called ad hoc margin on those days. Okay. Normally these are the two margins which are collected. Okay. So if you are buying or selling a futures contract, your broker collects margins. Normally your trading account has to be funded with margins before you can initiate a trade. Margins have to be paid irrespective of whether you buy. Yeah, एक second मैंने. It's working. I thought I have not started the. So you know that whenever you are buying or selling, you have to pay margins. So in case of futures, both the buyers and sellers have to pay margin. Okay, fine. In options, it is only the option writer, I mean, has to pay the margin. Option, person who has bought the option, he has to pay only the premium margin. It is called. Okay. Okay. Now apart from that, there is something called mark to market margin. Okay. Now what happens is that sometimes the price can go down. Okay, to such an extent that the loss is so much that your span margin and your extreme loss margin has to be again updated. Fine, because it has fallen below 11s, so that means you have to give some more money. Okay. Why such a high margin? Like, for Nifty, it's around 11.8% we just saw. For Reliance, it was around 18%. For Adani Enterprise, it was around 60%. It depends upon the volatility of the stock or the index. Fine. The index is least volatile compared to a particular stock. Okay. Reliance may be very less volatile. Fine. It all depends. For example, if the stock is having a very low beta, so normally it will be very less volatile, isn't it? So more volatile the stock, the chances are that it can, run away very fast, either on the downside or on the, upside. So there'll be either a gain to someone or loss to someone. Suppose I have got a big loss on a particular day, and the margin which I have given to the stock exchange, that is not enough to cover the day. So the stock exchange has to ensure, in all possible chances, the money should be remain with the stock exchange, so that if anything happens, suppose the person, dies, okay, or suppose something happens, so stock market has enough money to square off the deal. Okay, so they don't want the exchange should not, the buying and seller should not have any kind of a loss on account of bankruptcy of someone or because of some other kind of reason. Okay. So mark to market margin, can you read, Jasmine? They, okay, so these margins are collected only on when you are carrying your position. Okay, not on intraday. This thing, if you have entered for the intraday, then this thing is not applicable. But this is to make sure that your span margin and ELM margin are in remaining within the permissible limits. If the stock falls, particularly this thing day, it falls so much, then they will ask you to cover and see that you get a margin call on that day. Okay. So optional margin, we know there is no. Just can you read this? So if you are a writer, option writer, whether a call writer or put writer, you have to pay margins. Okay. Similarly, as you do in futures. But when you are, buying a call or, buying a put, in that case, you have to pay only the premium, depending on what strike price you have chosen. Okay. Yeah, premium is the margin. So, yeah. No, the span margin is actually calculated by the stock exchange. Fine. And the premium is not controlled by the stock exchange. It is driven by the market. Just to ensure that there is no loss on account of, somebody, backtracking from his commitment, that margin is collected. So there is a need of margin. That is what the stock exchange does. But the premium is driven by the market. Fine. So nobody is deciding what should be the price of oranges or mangoes in the market. Nobody. Okay, fine. Unless the government puts and says that this is a price, nobody should. But the government doesn't do that. Okay. So similarly, premiums, you can only know whether the premium is high or low because by looking at the Black-Scholes, model. Now let's talk about the settlement now. Now futures contract on index or individual securities, how they are settled. Now there is one called daily settlement. Okay, fine. Daily, the stock exchange will settle your account. That's called mark-to-market settlement. That I have not explained at the moment, but there is something called mark. What we did was mark-to-market, the margin. Okay. Now is mark-to-market settlement. So every day, if you are making a profit, the profit is going to be credited to your account. If you are making a loss, then that a loss is going to be debited to your account. Okay. So you have to have enough money in your account to take care of that either loss or profit. Okay. Now the settlement happens basically in case of index or stock price based on the last half an hour price of the future price. If it is daily settlement, then the last half an hour, whatever is the future price of a particular stock or an index, we will calculate the weighted average. Okay. And then that weighted average price will be shared with in the market. On the TVs we can find and Nifty shares that price. So that is the price on which the settlement is going to happen. Okay, fine. So closing price is last half an hour weighted average, and that weighted average price is called the future price, not the spot price. Okay. But in case of the final settlement, again the same it is, but here the capital segment price, half an hour last half an hour weighted average price will be taken for settlement of your profits. But if you are closing your position before the expiry, then it will happen on the Nifty futures price, half an hour. Okay. But when you are closing your position on the expiry, then it will depend on the capital segment half an hour price, last half an hour. Is it okay? Is it clear? So, you have to pay span and exposure margin, as I told you. Okay. So otherwise in the cash market, you have to pay the full price. So if you look at, there is a site called Zerodha. So what I have done is, so I can just take you to a site. Just watch. I think I have not, I've given the link only yesterday only. So otherwise you can go to zerodha.com margin. Okay, if you are having your this thing. So this is called future and option margin calculator. Okay, so go to FNO. Okay, fine, and then just go below. So you have this window. Okay, so say Nifty, for example. Let's check for any this thing. Exchange is NFO, futures, product is futures. So this is the contract. So I say Nifty. So suppose we are going for February contract. Okay, so I'm going for say 1 lot, or say I'm going for 10 lots. So I'll say add. So it will tell you that what is the span margin, what is the exposure margin, and total margin we'll get. Is that okay? So similarly, you can choose any stock. That is 2% and 3.5%. 2% for the index, 3.5% for the stock. Is that okay? So it is just giving you the margin. So that way you can just check for margin of any stock you want. Suppose, let's say you want to know the price of say Maruti, for example. Suppose you are taking a position on Maruti. Maruti say March, for example. Okay. Lot size is 50 only this. So you have a total margin of 13,34,000. Is that okay? So you can always look at what is the margin, what is the the span and the exposure margin. So this I have just given for Reliance, the same thing. So I'm just skipping that. Okay, the settlement mechanism once more. Just let's take a revision. So how the futures contracts are settled in India? Square off. That means the cash settlement. Okay, and physical delivery. Okay, at the expiry. So from October 2019, all the stocks in derivative segment will be physically settled if you fail to square off your position before the expiry date. So either you can, do a square off well before the expiry, but if you reach to the expiry and you have a position in the stock, then you have to do a physical delivery. Otherwise, a cash settlement. So I'm just going to explain.